What's up, everyone? It is E-Money, your BFFF, best financial friend forever. So when we're talking or when I'm talking with people, a lot of people don't have a number. And what do I mean by that? It's like every one of you should have a number. And that number is, how much do I need in total assets to be able to ride off into the sunset or go do something else or live the life that I want to live? Okay. And there is a number that is attached to that most people are just missing. And the worst part about it is that in life, you have to have some kind of an ideal. So you have something to compare your current scene to. And when we're looking about finances, there's a term called the wealth gap. And the wealth gap is basically the difference between what I currently have and what I actually need, and the gap in between there. Well, me and my advisor, Eric, tackle this today. We go through the formula of how to do it and make sure that it's a number that every single one of you absolutely understands, knows, comprehends, and knows how to minimize that gap every single year, because there are things that you can do to control your wealth gap and get it down there quickly. So I think you'll enjoy it. As always, please give us some feedback. Please like, share, subscribe. You know the drill, so that we can continue to do these long form content that we enjoy doing, so that you guys are more up to date, more up to speed on things you need to do to conquer your finances. Okay, I'll see you guys on the next podcast. Enjoy. Okay, everyone, welcome back. It's good to see you, Gersch.
It's been...
Where you been?
Where you been?
What do you mean, where have I been? I've been here.
No, you haven't. You've been in New Jersey, dude.
I've been out of town. I've been trying to drum up business so that you can, fund your swimming pools and, live a lavish lifestyle that you want to live.
Oh, come on.
Isn't that what happens?
Maybe.
So you can afford a generator for your house.
Yeah, it's probably time for that after 2 hurricanes in 2 weeks.
I'm definitely over the weather.
7 days of no power out of 14 kind of sucked.
Yep. Yeah, it was that many days for you?
Yeah, the first one we lost power for 3 days. The second one we lost power and internet for 4.
Wow. Well, we already did a podcast on preparedness and how utterly unprepared you were for this.
We did financial preparedness. I was ready financially. I was not ready with the generator.
And your solution was to get out of town, probably, wasn't it?
Thought about it.
As opposed to just like handle the environment in front of you so that you could survive.
Thought about it. More so Riley, my wife, wanted to evacuate for a minute, and then I reminded her, like, do you know what it's going to be like trying to get back to Tampa Bay with a million other people with one freeway? I wouldn't
even consider how hard that would have been. But
yeah, no. Yeah. Once she saw the traffic on I-75 just getting out, she was like, let's stay.
Yeah, probably a good idea. So, and I guess in light of that, we decided to talk about something that I think we talk with a lot of clients about, and something that a lot of people are always worried about. And I don't know, I guess it's just the fact of, do I have enough?
Yep. Can I retire?
Do I have enough? Well, yeah, I mean, I'm sure people think about, like, can I retire? But it's like, I hear, like, I've become accustomed to a certain lifestyle. I don't want to have a lower lifestyle than what I currently have, or I even want to have a better lifestyle than what I currently have. And I think at the back of most owners' minds, they're thinking, like, all right, I mean, I'm not going to hold on to this practice forever. I'm eventually going to sell. Am I going to have enough in income, assets, and resources to be able to essentially do whatever I want to do? And there is a number that's associated with that.
Oh, absolutely.
For the most part.
It's a number we calculate.
Yeah. And I would say that the vast majority of people, when they first approach us, or really any other advisor, is they have a wrong number of what actually is needed to be able to do that.
Agree.
Yep.
Agree fully.
And when I say a wrong number, it's usually on the low side.
Yep.
Of what they think they need. Because, and I've seen a lot of stats, and I've watched some other videos of like how prepared people are for retirement. And I think I saw one where it was like over 60% of people over the age of 55 or 60 years old only had like $100,000 saved for retirement. You believe that?
I'm looking it up right now. Average retirement savings by age. Oh, it's higher than I expected. Over 65, the average is 610,000.
Okay.
But
that's still okay. Okay. Let's go with that. 610,000 average.
Yeah. I mean, if you want to make that last, that's 30 grand a year.
Yeah. What's 30 grand a year gonna provide you? Even if everything's paid off.
Because you're thinking, use a 5% withdrawal rate. That's
even if, yeah, I mean, you'd have to do a minimum of that. You probably have to do higher than that. Probably like a 7% or 8%.
I'm saying a 5% withdrawal rate, which a withdrawal rate, as well, but in case our listeners don't, is what percentage of my assets can I pull out a year? So if I have $1 million, I can pull out, 5%, 50 grand.
Yep.
So on 600,000, that's about 30 grand. But the problem with withdrawal rates is once you go over 5%, your chances of running out of money because you're pulling money out faster than it's earning, they go up exponentially as you hit 6, 7, 8% withdrawal rates.
Yeah, for sure.
Exponentially. So 4 to 5% is the proven standard.
And the number that I hear right now that most people should have to secure retirement is right around $2 million.
Yeah, I mean, if you have $2 million, if you figure that's what $100,000 a year, plus if you have social.
Let's just keep it right there. Okay. Now, most of the people that we deal with make a lot more than $100,000 a year.
True.
Right. So the standard by which people tell the standard by which our industry tells people of how much they need in retirement assets is based upon a wage replacement ratio, right?
Yep.
And that's 60 to 80% of what you're making right now is what the target should be to secure a quote unquote your retirement. Yep.
Yeah.
And of course you'd add in Social Security and such like that. And look, I mean, that number is okay. It's better than what the stats are showing right now.
Yeah.
Right?
Yeah.
Because there's no way that most people are even remotely prepared. Remotely.
100%.
Yeah. I mean, it's staggeringly low. I mean, that's like if you need 2 million, and what'd you say the average was?
610.
Yeah, I mean, what percentage is that? That's like what's
less than a third. It's like 30%.
Yeah, you're 30% funded to where you need to be. That's terrible.
Yep.
That is terrible. So, okay. So I think the talk on what the number needs to start with an equation, or it needs to start with a different approach. Because most of the talk is how much do you have saved, right? And I know in our approach, we do it a little differently. It's how much actual cash flow do you want to have to start, right? So we have a name for it. I think we call it the desired minimum income. Dimmy?
Well, there's the two. There's the required minimum income and the desired income.
Yeah. So, but I think in most cases, we're going to talk about the desired income.
Yeah, I mean, that's what people should be shooting for. I mean, it's right in the name. The required income is how much you need just to survive. The desired is how much you need to survive and enjoy. You know? So yeah, desired is obviously the target. 100, okay. Absolutely.
And you can see the screen right now, yeah?
Yes.
Okay. So we start with a number, like what's the desired income number? Now, I think for most of the people that we're dealing with, when we ask them, like, what's your desired income number? Most of the people, most healthcare owners should be making at least a minimum of $200,000 a year. Between salary and profit distributions, they should be making at least that much. Yep.
Agree.
Okay. So we're going to say that I don't want your lifestyle to go backwards.
No.
So if we're going to say, let's have whatever your desired income level would be, let's at least keep it fairly equal to what you're making right now or close to it. Okay. And for most people that own a healthcare practice, it's over $240,000 a year. Right.
Yep.
So, and you're going to have people that make a little more than that, a little bit less, but let's say $240,000 a year. Okay, great. So that's the number. That's the number that now it could be 25,000, could be 30,000. It's different for everybody, but I'd probably say of all your clients on average, that's probably where the target would be for a lot of people.
Yeah, I would say 20,000 a month is the average.
Okay. So great. So the next question is then, well, how much am I going to need in total assets, to be able to generate $240,000 a year? And this is where people get confused, I think, right? Yep. Because we're looking for a total asset number, which does not mean that we're just looking at how much money is in your retirement accounts.
No, it also has to include the value of your practice, the value of if you own commercial or rental real estate.
Everything
those are
you
all
own.
income producing assets.
Correct. And we can even assign a value to like Social Security too.
Yep.
Couldn't you?
You could.
So, yeah. So when we say your required asset base, I mean, the formula of how to calculate is really simple. You just take whatever your income amount is and you divide it by 5%.
Yep.
Now we could do 6, you could do 7, I think 5 is probably a pretty conservative number at this point in time. And all that's going to do is give you your asset base requirement.
Yep, 4.8 million in this case.
Yeah, and that is the number. Okay, great. If I want $240,000 a year, I take that, divide by 5%, because I figure if I can at least average 5% on all my investments, which you should be able to do, then that's going to tell me how much of a total asset base that I need.
Yep.
$4.8 million. Okay. So then, great. So then the next step of the equation is what you currently have right now.
Yep. Your savings, your investments, your business. Now, I would say, looking at this slide, it's missing one key word.
Which is?
It should say in parentheses, including the net business value.
Fair enough. Right. Because you're going to have to pay tax and
you're going to have to pay tax and you're going to have to pay off all debt.
Yep.
So
for sure. So, but I think the point is that number one, how many owners, when they first come to us, actually even know how much their assets are?
Very few.
Very few. Okay. And even fewer of them actually know what their DIMI amount is.
Yeah, I mean, they know what's in their retirement accounts, and that's about it. They have no idea what their business is worth.
Nope.
Not
at all.
No idea, like you said, even how much they need to retire.
So after you do this, you then have now your wealth gap.
Yep.
Right? Your wealth
gap. What you need minus what you have. So
I need 4.8. I have 3.4. That means I have $1.4 million of a wealth gap.
Yep.
It's just that simple,
It really is.
It's just not that complex. Like, that is the wealth gap that you have. And now the target is established. And I know exactly what I need from here on out to be able to get to where I want to go. Like, I find it hard to believe it's more complex than that.
No, and your wealth gap, I mean, the 1.4 million in this case, that's what you need to put away, grow your business value, earn in return. Like, all of those things function to close the gap.
Yeah. So let's talk about that. Because when you tell somebody they got a $1.4 million wealth gap, or a $2.5 million wealth gap, or a $3.4 million wealth gap, it seems like a lot of money.
Yeah, it's definitely a jaw-dropping moment for most.
Okay. So I want to break down a little bit of that wealth gap, because while it seems like it's a huge, because now all of a sudden people think, oh my God, I got to save $1.4 million.
Yeah, not true, but
yeah. It's like, no, you don't. You don't need to save $1.4 million.
No.
what are the three remedies to minimize a wealth gap?
Well, number one, you already said saving.
Yeah.
You are going to have to save.
Yeah.
Number two is growing the value of your practice.
Yep.
And then number three is just the return you earn on your investment.
Yeah, exactly. Okay. So let's take number one, increase savings.
Okay.
So I think the methodology is pretty well established of like what you need to do.
Yeah.
You just need to accelerate taking profits out of the practice.
Yep.
Which seems to be the biggest barrier that most owners have, is they want to keep a ton of cash in the business, or they simply don't have a method or a system for extracting money out of the practice. So you got to get that established.
Yes.
Almost immediately, based upon your time frame. Now, one thing we did not talk about was I have a wealth gap, but I also have a time frame, right? So when you're talking about your time frame, that could be 5 years, that could be 10 years, that could be 15 years, whatever it is. So the wealth gap is simply, so if, let's say I have a 5-year plan. What's 5 divided by 1.4 million?
Let's see. 280.
Okay, $280,000 of wealth I need to create every single year. Okay. So now how am I going to do that? So we talked about increase your savings. And, obviously the method of that is just setting up a system that's going to take profits out of the business and be used for you to accelerate your quote unquote retirement. That's it. That's it. So it's, pretty well established, what we do, how to do that. It's taking
what we do, how we do it. Yeah.
So the second method is I think the method that most people don't really realize, but is way more powerful, which is increase the value of the business.
Yes. Yes.
And how quickly that can happen.
Well, the way that I always describe it to clients is like, when you sell your business, right, you're going to sell your business at a multiple of, call it the profit. It's the adjusted profit, but just for sake of ease, multiple of profit, right? And let's say that multiple is 6. That's probably pretty fair across the industries that we work in, some higher, some lower. So if I have profit of $200,000 times 6, my business is going to sell for 1.2, right?
Okay. So $200,000 profit, a multiple of 6, $1.2 million. I got it.
Well, every dollar that you increase that profit, you're getting a 6x, a 600% return, right? Because if I increase,
say that again, Gersch.
Every dollar I increase my profit, I'm getting a 600% return on that dollar when I sell. So if I can grow my business from 200 to, I don't know, let's say 250 of profit, that's 1.5 million. That 50 grand of profit is worth 300,000 of sale value. And there's no, in a 5-10 year time horizon, there's no other investment that's going to give you a 600% return.
No,
nowhere near it.
Not at all.
You'd be lucky to get 100% return elsewhere.
Yeah. So this is the math we need to get practice owners to do. For every dollar of profit, you guys got to remember, like a healthcare practice is going to be valued based upon a multiple of earnings or net profit. Simple as that. Okay. In most of these industries, the multiples on a fairly well-run practice that, has 2 to 3 associates or more, is in a fairly good demographic, is doing, fairly good numbers and has a good profit margin, is going to be in a range between 5 and 10, I would say. Some industries are just going to be more, right, than others.
Yep. Yeah, absolutely.
Okay. But we'll go on the high side. If someone's got like a $3 million practice, I mean, that's doing 20% margins. That's 600,000. I mean, you're probably looking at somewhere between a 7 and an 8 multiple.
Yeah.
Okay. So every dollar of profit is now worth 7 to 8 times in value.
Yeah.
And this is where I just think people get lost. And they start worrying about outside things and outside investments. And you're just like, dude, like this thing's worth $2 million right now. If you got your act together, lowered your cost of goods sold, got more production from your staff, okay, increased, patient visits and average transactions, whatever that would be, you could take this thing from a $300,000 profit to a $400,000 profit. And that extra $100,000 may not seem like a lot of money to you personally, but you just increased the value of your business by $800,000 by doing that.
Yep.
Okay.
It's that simple.
It's just that simple. And when you start breaking down the numbers and you continually do that, even if you have a target of like, I just want to increase my profit by $25,000 or $30,000 every single year,
Yeah, it becomes much more manageable when you look at it over a 5-10 year time horizon.
Yeah. Like then I'm going to be able to get to my number.
Yep.
At that point. And I think that's the established thing that people have to do, because, I don't think the valuations are going to go down, anytime soon.
Not in the foreseeable future. I agree.
There's a very good opportunity right now if you want to be able to reduce your wealth gap. So in that case, if I have let's say $1.5 million practice that's doing a 20% profit margin. So what is that? That's 300,000 in profit. Okay. And that practice, let's say it sells for like a 6 or
1.8.
Yeah. $1.8 million. Okay. And then the next year I increase the profit by $30,000. All right. So that's 330. Now what's the value of the practice? What's 330 times 6?
1.98. Call it 2 mil.
Almost 2 million.
Yep.
So I reduced my wealth gap by $200,000 in 1 year. Right?
Yep. Just by focusing on increasing your profits.
Yeah. So I reduced my wealth gap by $200,000 in 1 year. Okay. That doesn't even count what I saved, which was maybe
if you saved your 10% of revenue, there's another 180,000.
Yeah. So let's say I just increased my overall net worth by $380,000 in 1 year.
And that's not even counting any return you earned on your other investments.
And let's say I had a great year where my investments earned 10%.
Yeah.
And I had $50,000 of appreciation in my investments.
Yeah, you're talking, 400,000, 450,000 of improvement in 1 year.
It's crazy.
It adds up quick.
100% adds up so amazingly fast.
Yep.
So that's where the attention needs to be. Now, the last category was the investment portfolio.
Yep.
And all I would tell people there is just like, you don't need to take crazy risks with your money. And because when you're saving that amount, when most of the return and the wealth gap is going to be handled by the increase of the value of the business, like you don't need to get like super, super aggressive on your investment portfolio.
No.
Like you can keep it in a well balanced, stock or bond portfolio, insurance-based products, real estate, whatever it is, but you don't have to get like,
you don't have to swing for the fences.
Yeah, you don't have to get super aggressive in doing that. And I think that's probably the biggest challenge for most people, is because when you feel like you're behind, you press.
Yep. Yeah, when you feel like you're behind, you take risks, and sometimes it's necessary, but a lot of times it's not, because you're not looking at the whole picture.
Yeah.
So
it's pretty amazing. So kind of like summing this up then, the wealth gap is the target that most people should be looking at and addressing. What is your wealth gap? Like that's on the personal side, when you're doing your personal financial planning, when you are looking at all your numbers, looking at all your stuff, that to me should be like one of the number one goals that you have.
Yeah, you have to know your number.
Yeah.
You have to know your number.
Know what that number is.
Simple.
Yeah. Because when it comes to like, creating the cash flow and doing a plan of like how we're going to, meet that number. I mean, that's what we do.
Yeah.
We're going to show you how you're going to get that number. Okay. Now, some people are going to argue too that, well, that number, all you're doing is saying, I'm going to live off of the 5% interest and never pay down or touch the principal of your investments. What's your argument to that? Do you have one?
I mean, maybe. It's a tough. In a perfect world, yes. In a perfect world, we earn this just about perfect 5% a year.
Yeah.
And we pull out this perfect 5% a year. But in practice, life happens. There's years that your account is going to be negative 10% and you pull out 5%. That's 15% gone. Now you have to earn 20% on your pie to get back to even. So the math, it just becomes much more complicated. But I guess the short answer is at least if you look historically, if you're pulling out that 5%, you're going to probably die with a little less money than what you retired with, but it should be pretty close.
Yeah. And I guess what I was going for there is most of the simulations are like, this is you pulling out money and you running out of money, barely being able to make it. Like your investable assets significantly go down.
Yeah. I mean, there's nothing worse than working your whole life just to end up broke in your early 80s.
Yeah, exactly. So I think the reason that we come up with the calculation that the way that we do is because I kind of consider that a factor of safety. Like I want to make sure we have a big enough buffer so that, just like you said, there's going to be events and economic crisis and all these things that no one knows when they're going to happen, or you're going to be able to medical costs.
Yep.
Probably want to help, you may have to bail out a kid or something like that. Who knows?
Yep.
Who knows? So when we come up with that number, we're just trying to live off of the interest earned at first, because I don't know what kind of factors are going to happen over the next 25 or 30 years. And quite frankly, you're not going to be able to work like you did. Okay. Yeah. So we need to make sure that we have way more than what we think.
Yep.
Okay. And that's why we'll probably overcalculate that number, because some people argue, well, that's just way too much. That's just way too much. I'm like, well, okay.
I would rather get to, the end of my life and die with more money than I meant to than,
who cares?
Die poor.
Yeah.
Because I didn't save enough. The worst case is more money goes to your family.
Yeah. Yeah.
Or
what's
wherever
the worst?
You want it to go.
Yeah. That's not a worst case.
Exactly. There's no downside to over saving.
No, or having more.
But there's a ton of downsides to under saving.
Yeah. I mean, because to your point, I mean, you may have bigger expenses. People that think they don't have any expenses as they get older, you're like, sheesh, that's not what we've seen.
Not how it works in real life.
So, all right, good. So your wealth gap, that's your target. Make sure you guys are addressing that. And if you're not getting any help on that, feel free to reach out to us. Go to econologics.com and we would be more than happy to do an intro call with you. Establish your wealth gap. Make sure you guys get on track. Minimize that wealth gap. It is the target that all of you should be shooting for. And it is a primary target that we're trying to help our clients with. All right, man.
All right. Till next time.